So I want you to imagine for a second that you are managing a massive portfolio, like billions of dollars.
Okay, a lot of pressure.
Right, a ton of pressure. And you decide to put all your chips on the flashiest, fastest, most technologically advanced race cars on the track. I mean, you've secured the best engines, the most elite drivers, the absolute pinnacle of aerodynamic design.
Sounds like you've done everything right. Everything looks like a guaranteed win at that point.
Exactly. You just, sit back in the grandstands and get ready to watch them completely lap the competition.
Yeah, you're just waiting for the trophy.
But then, right in the middle of the race, you look down from the stands and you realize that the track itself is fundamentally changing. Like the smooth, pristine asphalt is just dissolving.
Oh, wow.
Yeah, the entire circuit is turning into this massive, thick, inescapable mud pit. Suddenly, it really doesn't matter how incredibly fast your race car's engine is, because the environment it's running in has completely trapped it.
Right, because the rules of the race change entirely in that moment. I mean, speed is no longer the defining factor, traction is.
Yes, traction is everything. And today, welcome to our deep dive. We are taking a really close look at a fascinating, honestly, highly aggressive market thesis that argues this exact scenario is playing out right now in the global tech sector.
It's a really compelling source script we have today.
It is. We're looking at a massive tectonic shift happening just beneath the surface of the market. Analysts are calling it a silent AI rotation. And our mission for this deep dive is to uncover this shift, which suggests that massive wealth is preparing to move away from the household legacy titans we all know and rotate toward a very surprising hardware anchor.
Yeah, and it's a phenomenal thesis to unpack because it completely challenges the conventional wisdom that has just dominated the last few years of tech investment, especially regarding the artificial intelligence boom.
Definitely. Now, just a quick note for you listening before we jump into the mechanics of all this. Whether you are prepping for a high-stakes finance meeting or you're just insanely curious about the actual physical bottlenecks driving the AI revolution, this deep dive is going to give you the ultimate contrarian perspective on where the tech world might actually be heading.
Right. It's a very different lens to look through.
But, and this is crucial, we are simply unpacking a highly specific, very aggressive argument presented in our research today. We are not endorsing this as financial advice, obviously, and we certainly aren't picking sides between the market bulls and the bears.
No, not at all. We are strictly here to impartially report and analyze the rather explosive logic laid out in this thesis.
Exactly. We just want to pull apart the mechanics of the argument.
Right. Look at the structural and macroeconomic claims it makes and truly understand the why and the how behind this proposed tectonic rotation.
Okay, so to reveal the surprising winner of this AI rotation, I feel like we first have to understand why the current champions, those flashy race cars in our analogy, are suddenly sinking into the mud.
Makes sense. Start with the problem.
Right, because for the last couple of years, the playbook for generating returns was incredibly easy, wasn't it?
Oh, it was the definition of a crowded consensus trade. I mean, the traditional strategy was simply hiding out in what's known as the Magnificent Seven. So companies like Google, Microsoft, Amazon.
The giants.
Exactly. Active fund managers could just buy these mega cap tech stocks, sit back, watch them fund massive artificial intelligence capital expenditure, or CapEx as we call it, and just collect the gains.
It felt like a total one-way street.
It really did, but the macro landscape has completely changed. Like you said, the smooth asphalt is gone.
Right. We are suddenly looking at a reality where crude oil is spiking, inflation vectors are proving stubbornly persistent, and interest rates are staying significantly higher for a lot longer than anyone expected.
Yeah, higher for longer is the new reality.
And because of this specific combination of factors, Wall Street is heavily discounting the long-duration growth models of companies like Google and Microsoft. Active investors are suddenly demanding immediate efficiency for those massive AI CapEx budgets.
Yeah, the environment has violently shifted, really, from rewarding unconstrained futuristic growth to demanding immediate returns on capital.
Okay, let's unpack this, because I want to make sure the connection here is crystal clear for everyone. If Google and Microsoft are essentially, printing money with their core search and software businesses, why exactly does a spike in crude oil or a higher interest rate environment suddenly make their massive AI budgets look like a bad bet?
It's a great question.
I mean, these are the richest companies on earth. Why does the macroeconomy matter so much to their AI research?
Well, what's fascinating here is that it comes down to the physical reality of what AI capital expenditure actually is. Like, when we talk about AI CapEx, We aren't talking about hiring a few extra software developers in Silicon Valley.
Right, it's not just paying guys to write code.
No, not at all. We are talking about building sprawling, hyperscale data centers. That means you're buying massive plots of land. You have to secure gigawatts of electrical power.
Which is where the crude oil and energy costs come in.
Exactly. And building industrial-scale liquid cooling systems and purchasing tens of thousands of specialized processors.
It's heavy industry. I mean, it literally takes years to build one of these facilities before it even runs its first AI model.
Yes, it takes years to build and potentially, well, a decade to actually turn a profit on that specific facility.
Wow. 10 years.
Right. So when Wall Street values these investments, they are heavily relying on future money. But high interest rates act like this heavy gravitational pull on the value of that future money.
Because inflation eats away at it.
Exactly. If active fund managers can get a guaranteed, say, 5% return just sitting in treasury bonds today, suddenly waiting 10 years for Microsoft's new data center to pay off looks much less attractive. The math just no longer supports patiently waiting.
So wait, just to clarify, active fund managers aren't necessarily doubting the AI revolution itself, right? They just literally cannot afford to wait a decade for the infrastructure to pay for itself.
Precisely. Their job is to generate outperformance today. If they just sit in stagnating mega cap stocks while interest rates remain high, they underperform the market.
And they lose their clients.
Right. So they start demanding efficiency. They want to see exactly where that massive AI budget is going, and they want returns now, not in 2035.
Okay, and because these active managers are terrified of inflation eating their returns, they're basically tearing apart the Mag 7's balance sheets, forensically examining where that money is actually being spent today.
Yes.
And that leads them right out of the boardroom and directly into the server racks. Which brings us to a massive physical bottleneck in the AI revolution.
Yeah, and this is where there is a critical misunderstanding in the broader market right now.
How so?
Well, when the average person thinks of AI, they tend to think purely of processing power. They think of the billions of dollars Google, Microsoft, and Amazon have spent hoarding these high-performance NVIDIA GPUs.
Right, the brains of the operation.
Yeah.
The incredibly expensive engines of those race cars we talked about.
Exactly. But here is the physical reality. Those processing units, no matter how powerful they are, no matter how many billions you spent on them, they are structurally bottlenecked if they cannot access data fast enough.
Oh, interesting.
Yeah, you can have the most powerful processor in the world, capable of trillions of calculations a second. But if it's just sitting idle waiting for data to be delivered to it from the memory banks, you are basically burning billions of dollars in inefficiency.
Okay, here's where it gets really interesting. Because the ultimate contrarian thesis we're exploring today points to a company that most people probably associate with, like old thumb drives or digital camera memory,
Right.
SanDisk. The argument is that SanDisk holds the master key to this exact data delivery bottleneck. Going back to our analogy, it's like Google and Microsoft bought the absolute fastest, most expensive sports car engines in the world, those NVIDIA GPUs, but they are trying to feed them fuel through a tiny plastic drinking straw.
That's a perfect way to visualize it.
And the thesis argues that SanDisk is the one building the massive proprietary fuel pipeline to actually make the engine work.
That is exactly the dynamic at play, and it's really crucial to understand how SanDisk is building that pipeline. I mean, they aren't doing it by just churning out slightly faster versions of those old thumb drives.
Right, it's got to be something way more advanced.
It is. They have engineered a proprietary solution called the Stargate ASIC controller, which works in tandem with their leading-edge 332-layer BiCS10 flash architecture.
Okay, we need to pause and define these terms because this sounds like incredibly dense jargon, but it's really the entire foundation of why they might be taking over the market. Let's start with the Stargate ASIC. What actually is an ASIC and why does it matter?
Sure. So ASIC stands for Application-Specific Integrated Circuit.
Okay.
Think of the standard CPU in your laptop as a jack of all trades. It can run a web browser, play a video, edit a document. It does a million things adequately.
Right, it's a generalist.
Exactly. An ASIC, on the other hand, is a custom-built piece of silicon designed to do exactly one job and do it with absolute, uncompromising perfection.
So it has a single mission in life.
Yes. And the Stargate ASIC's single mission in life is to act as the ultimate traffic controller between the memory banks and the NVIDIA GPUs. It is custom designed to manage massive, sustained data workloads without stuttering or failing.
Okay, that makes sense. And what about this 332-layer BICS10 flash architecture. I know flash memory is how data is stored, but what does 332-layer actually mean in the physical world?
Well, think about urban planning. If you need to house 100,000 people, you can either build massive suburban sprawl that stretches for miles, or you can build skyscraper.
Right, go up instead of out.
Exactly. In traditional memory chips, data cells were laid out flat, like sprawl. This meant the electrical signals, the electrons, literally had to travel longer physical distances across the chip to retrieve data.
Which I'm guessing takes more time, creating latency.
Right. What SanDisk has done is build microscopic skyscrapers. They have stacked the memory cells vertically, 332 layers high.
Wow, 332 layers.
Yeah, and this drastically shrinks the physical footprint of the memory, meaning the data is packed incredibly densely. So when the GPU asks for a piece of data, the electron has to travel a microscopic vertical distance rather than a long horizontal one.
So if the standard memory chip was that plastic drinking straw, this 332-layer architecture managed by that Stargate ASIC is basically like bolting a high-pressure fire hose directly to the engine block.
That's a great way to put it.
You're absolutely flooding the GPU with data as fast as it can process it.
That is the exact mechanical advantage. And this brings us to a massive distinction in the market. By combining these two technologies, SanDisk is no longer selling generic cyclical commodity chips. They are selling specialized tech platform nodes.
Okay, a commodity being something where you can, easily swap out one brand for another. Like, if you just need basic memory, you find whoever is selling it cheapest that day.
Exactly, which creates a race to the bottom for pricing and makes traditional hardware a highly unstable business. But what we are analyzing here is a specialized tech platform node. And if we connect this to the bigger picture, the thesis states that hyperscalers, the Amazons and Googles building these AI data centers, are actually legally obligated to buy these specific SanDisk nodes if they want to hit their performance metrics.
Wait, legally obligated to buy them? That is a massive statement. How does a company get legally forced to buy a specific brand of memory?
It happens at the architectural design phase. When a hyperscaler designs a multi-billion-dollar data center, they sign contracts promising a certain level of performance to their clients.
Right, they have service-level agreements.
Yes, and because the architecture of these new AI data centers is so specifically tuned to this proprietary technology, you cannot just swap it out. To get that NVIDIA GPU to operate at peak efficiency, the entire systemic design is structurally dependent on SanDisk's specific nodes.
Oh, I see. They have engineered the only fuel pump that actually fits the engine.
Exactly. If the hyperscaler uses a cheaper generic memory chip, the GPU starves for data, the data center misses its performance targets, and they breach their client contracts.
So because SanDisk has solved this exact unavoidable fuel line bottleneck, their financial reality has just completely decoupled from the rest of the struggling tech sector.
Completely decoupled.
I mean, we talked earlier about the Magnificent Seven facing slowing core growth and macroeconomic anxiety. But the numbers for SanDisk in this script are in a different universe. Their recent revenue skyrocketed 251% year over year.
Which is crazy to think about. A 251% increase in top-line revenue for a hardware company of that massive scale is just staggering. It shows absolute hypergrowth in a market where almost everyone else is pulling back.
It really is. And furthermore, the research points out that they are entirely debt-free.
Which is a complete superpower in a 5% interest rate environment.
Yeah, let's expand on that. Why is zero debt such a big deal for a hardware manufacturer right now?
Well, in the era of zero interest rates, debt was practically free money, right?
Right.
So hardware companies loaded up on debt to build their fabrication plants. But today, with rates high, refinancing that debt is brutally expensive. It eats directly into your profits.
Okay.
Because SanDisk operates with zero debt, they don't have hundreds of millions of dollars in interest payments just bleeding out the back door. Every dollar of profit they make can either be reinvested into research or returned to shareholders. Their competitors simply don't have that flexibility.
And that flexibility is backed by an enormous safety net, apparently. The script notes they have locked in a minimum of $42 billion in contractual revenue that runs all the way through 2028.
Yes, $42 billion.
That creates a massive guaranteed cash flow floor while the tech giants are under immense pressure. But I want to zero in on one specific number that really jumped out at me from the analysis.
Let's hear it.
The research notes that SanDisk's gross margins expanded to an incredible 78.4%, and that those margins are guided even higher.
Yeah, that is a number that forces institutional analysts to completely rewrite their financial models.
So what does this all mean? Because the research literally calls that 78.4% a software-like margin. But wait, I had to push back here.
Go ahead.
SanDisk makes physical hardware. They are manufacturing complex physical silicon in multi-billion-dollar hyper-clean fabrication plants. How is a margin that high even mechanically possible without it being like a low-overhead software subscription model?
It's the right question to ask, for sure. And the answer goes straight back to the physics of the bottleneck we just discussed. In traditional hardware manufacturing, your margins are constantly compressed because you are competing on price.
Right.
You spend $5 billion building a factory, and then you have to sell your chips for pennies on the dollar just to move the volume before your competitor undercuts you.
Right. The classic race to the bottom.
But when you own the Stargate ASIC and the 332-layer architecture, you aren't competing on price. You are competing on performance.
Oh.
Think about it from the perspective of the hyperscaler. If Google is spending $10 billion on an array of NVIDIA GPUs, and those GPUs will only work at maximum efficiency if they use SanDisk's proprietary memory nodes, Google is not going to haggle over the price of the memory.
Because the cost of the bottleneck is infinitely higher than the cost of the hardware itself.
Exactly. If a $10 million memory order is the only thing preventing a $10 billion GPU investment from becoming a massive paperweight, you have absolute pricing power. SanDisk isn't pricing their nodes based on what it costs to manufacture the physical silicon. They are pricing based on the immense value of the bottleneck they are eliminating.
They are charging for the master key to the vault, not just the metal the key is made of.
Beautifully said, yes.
And this is where the narrative really accelerates. When we take all of these elements and put them together, we arrive at what the thesis describes as the perfect storm for a violent market rotation.
The perfect storm, indeed.
We have the Magnificent Seven stagnating, terrifying, the institutional investors who absolutely need to generate alpha today. And on the other side, we have SanDisk flashing zero debt, a $42 billion guaranteed cash flow floor through 2028, and unprecedented 78.4% software-like margins.
The contrast between the two is just extreme. And in global financial markets, extreme contrast is what drives extreme capital movement.
Right. So the argument is that this creates the exact setup for a violent re-rating in the stock market. The logic states that as active managers realize they are trapped in these heavy, mud-bound mega caps, they will basically hit the panic button.
Yep, they will.
They will rotate billions upon billions of dollars out of the legacy tech titans and flood it into pure-play growth nodes like SanDisk.
And panic is the operative word here. Institutional capital doesn't move slowly when it realizes it's trapped. It moves in massive, coordinated waves. When everyone rushes for the same safe haven, it floods the new asset class, driving the valuation up incredibly fast.
But the thesis layers even more fuel on this fire.
Okay.
It says you have to combine this institutional wall of capital with a massive, front-loaded corporate share buyback from SanDisk.
Right, using all that cash.
Exactly. Remember that zero debt we talked about? They have the cash to just buy their own stock off the market, heavily reducing supply. And on top of that, there's an intense short squeeze against bears who mistakenly still think SanDisk is just a legacy hardware company.
Which is a very dangerous position for those bears to be in.
Yeah, the claim here is that this won't be a slow, multi-year grind. The source argues that upcoming August catalysts could make the math go literally vertical, blasting the stock past its previous high and straight toward a valuation of $3,300 or more.
A vertical move to 3,300 is the definition of an explosive momentum trade. I mean, the mechanical combination they're describing, a frantic institutional rotation, a massive corporate buyback reducing the float, and a short squeeze forcing bears to buy to cover their losses. It is essentially a textbook recipe for immense, explosive upside volatility.
But okay, let me play devil's advocate for the listener here. We are looking at a $300 projection for a company making silicon chips. Historically, chip stocks have always been notoriously cyclical, right?
Oh, very much so.
They boom when demand is hot, supply eventually catches up, prices crash, and they bust hard. So if we're looking at this objectively, based purely on the mechanics, isn't there a massive risk that this 3,300 projection is just getting caught up in the AI hype cycle all over again? Or are we just slapping the hype onto a different company's name?
Well, this raises an important question, maybe the most important question of the entire analysis, and it's exactly what the short sellers are banking on. The bears believe the historical rules of the semiconductor cycle still apply. They think the music will stop, demand will normalize, and the stock will crash.
Right, the classic bust.
But the counter-argument we're exploring today is that viewing SanDisk through that old cyclical lens is a fatal miscalculation.
Because of the financial decoupling we discussed earlier.
Yes, and because of the structural necessity of the product. The thesis argues this is an asymmetric bet because SanDisk has permanently decoupled from legacy consumer electronics.
Meaning thumb drives and SD cards.
Exactly. By providing these specialized ASIC and 332-layer nodes, they aren't just riding a temporary wave of laptop or smartphone sales, they are becoming the premier foundational anchor of a brand new global AI infrastructure ecosystem.
So they are the rebar in the concrete foundation, not just like the paint on the walls.
Exactly. The argument is that the old rules of cyclical boom and bust are functionally obsolete for this specific company because you cannot easily rip out and replace the foundation of a data center.
Oh, that makes a lot of sense.
Furthermore, if the hyperscalers are legally locked into these specific nodes through 2028 with $42 billion in contracts, the traditional boom and bust cycle has effectively been suspended by sheer contractual force.
Because it's guaranteed demand.
Right. Therefore, those short sellers betting on a cyclical bust are fundamentally misreading the architecture of the market. They get trapped in their short positions as the revenue keeps flowing, which forces them to buy back shares at higher and higher prices, just to cover their losses.
Which only accelerates that vertical climb toward 3,300.
Exactly. It just feeds the fire.
Wow. It is a breathtaking financial thesis when you lay all the pieces out like this. Let's quickly recap the journey we've taken today. We started at the highest macroeconomic level, looking at how stubborn inflation, high interest rates, and spiking oil are acting like a mud pit, just dragging down the long-duration data center investments of the Magnificent Seven.
Yeah, and we examined how those heavy macroeconomic factors force active fund managers to demand immediate efficiency, basically sending them hunting for exactly where the CapEx money is flowing today.
Then, we zoomed all the way into the microscopic brilliance of the engineering. We looked at how the Stargate ASIC and the 332-layer flash architecture act as this high-pressure fire hose, solving the physical bottleneck of data delivery that is holding back the world's most powerful AI processors.
Right, and we unpacked how solving that specific physical bottleneck grants massive pricing power, translating into zero debt, $42 billion in locked-in cash flows, and those unprecedented 78.4% software-like margins.
And finally, we zoomed back out to look at how those two realities colliding, the stagnant Mag 7 and the cash-rich hardware anchor, could trigger a market-shaking panic rotation, potentially sending this valuation completely vertical.
It really is a fascinating collision of forces.
It is. Understanding these underlying physical bottlenecks truly gives you X-ray vision into where the real power lies in the AI revolution. It's not always the flashiest brand name on the outside of the building. Sometimes the real power is held by the company holding the master key to the digital plumbing.
Exactly. The physical realities of technology will always constrain the theoretical possibilities. If you control those physical constraints, you inevitably control the entire ecosystem.
And that brings us right back to our mud pit analogy. It really doesn't matter how fast the Google or Microsoft race cars are if the track gives way beneath them. The one who figures out how to pave the new track is the one who ultimately wins the race.
Well said.
I want to leave you with one final lingering thought to mull over on your own regarding this power dynamic. We noted earlier that hyperscalers are often legally obligated to buy these highly specialized nodes to optimize their data centers, simply because the architecture demands it.
Right, they have no choice.
So if a single hardware provider becomes so utterly foundational to the mechanics of artificial intelligence that the world's biggest tech giants have absolutely no functional or legal alternative, at what point does the plumber of the AI revolution actually hold more power over our technological future than the household names building the AI itself?
That is the multi-trillion-dollar question we all need to be asking.
Something to seriously think about the next time you see a massive headline about the latest AI boom. Thanks for joining us for this deep dive.